what just happened? What was this event on 10th of October?
It was bad. Even personally, yeah, I lost money too.
Why Wall Street is so much attracted to this concept of tokenization?
So I give you an example. For me, again, old guy, having been in TradFi, I have irregular bank accounts. I buy my treasuries in my regular brokerage account, and I buy my equities in my usual regular bank account. Why? Because for me it's cheaper than doing it in a tokenized.
So I wanted to know, first of all, your view about the future of this whole Perpetual DEX thing. And secondly, what is BitMEX actually, planning here? Is BitMEX also planning something like this?
I would say not as, it's clear cut, but not as black and white, I'd say. So just to answer your latter one, we are not planning to set up a Perp DEX. Just personally, if you hear me discussing in private, I never call them cryptocurrencies. I always call them coins.
So if you had $1,000 today, how would you invest it and where would you invest in crypto?
Tier 2, layer 1s. Yeah, for me, I would go for the ones that are not in focus right now, but where the chance is high that they will get in focus. And then it's exploding.
Hello everyone, hi, welcome to yet another episode of Voice of Web3, powered by CoinGape and Block of Fame. So guys, a lot is happening in crypto. We know that past few weeks have not been really well for the crypto community as such, and it's just bloodbath everywhere. And there are so many questions I know you have. There are so many unanswered queries we all have that we need answer to. And we were actually requesting a lot of people who can answer these questions. So gladly and luckily, we have somebody today who has the knowledge, who has the experience to help us all understand what is happening in crypto and also to help us understand what may be the move forward. So, guys, today we have on our podcast Stephan Lutz. Stephan is the CEO of BitMEX right now. BitMEX, as you all are well aware, is one of the world's most influential crypto derivatives exchange. Stephan, with a background in global finance, risk management, and digital asset infrastructure, has led BitMEX through a phase of renewed institutional focus, stronger compliance, and product innovation. Along with this, Stephen also brings deep insight into how professional traders, market makers, and Wall Street operates in crypto, making him one of the most influential people right now who can help us all. So, Stephen, welcome to the stage. Welcome to Voice of Web3 and Block of Fame. Glad to have you here.
Hey, hello. Good to be here. I'm looking forward to the discussion. And I'm humbled by your introduction. Thanks for that.
No, see, a lot is happening in crypto, and we were just, going through the list of speakers and esteemed people we can call, and your name was the first that came there, and we are so lucky to have you. We are so glad that team could connect with you. So thanks a lot again.
Sure. Let's dive into it. So what are the questions?
Crypto is a very difficult place to be in right now. We understand that, and we asked our, audience that, hey guys, Stephen is coming on the podcast. What should be our questions? Where should be headed? And, the first question was, what just happened? What was this event on 10th of October that took place? Lots of exchanges, malfunctioning, so many liquidations, and I think it was definitely one among the worst liquidations in crypto or even global finance we have seen in the recent past. So definitely, people are looking for answers. Many have lost money and many have lost their, tokens they have been holding tier two. So yeah, if you can shed some light on it, and I think that will be the best way to start this podcast.
Yes, of course. Let me start with, not right. What happened? This is, I wouldn't say not difficult to say what actually happened, because you have public data. You can look at the blockchain. Of course, we've been in the market for now more than 11 years. So yeah, I have something to say, but I just want to make sure that people take that into context. Number one is, I think on general terms, and not to mute it, right? As you say, individually, a lot of people have lost a lot of money, and we should dive into this. I'm happy to do that. But on the larger, grander scheme of things, actually the market worked as designed. That sounds pretty difficult to grasp intuitively, but what do I mean? So first of all, we need to make sure that we understand markets work. Let me just have a look. Yeah, that markets work as designed. What does it mean? In TradFi, for the likes and for the benefits of stated investor protection, you have circuit breakers, you have companies interfering with price discovery, you have market access requirements, so not everyone can trade or invest into what they want, right? And then you have lower volatility. This market is 24/7 undisturbed pricing mechanism. That means information flows freely, and then after the information flew freely, traders are more free to exert on their opinion. And this is what we saw, just in broad terms. Number two, what worked as well is if you look at what happened during great financial crisis, where I was, not part of in terms of the sources, but I cleaned up a lot of banks in my previous work, was actually that pressure was suppressed for a long time, and then it unloaded in a time, and it couldn't be really dealt with in a good way. Whereas in crypto, if you look at the FTX debacle and the subsequent bankruptcies, if you look at this now, if you look at further or earlier incidents, it was always bad for individuals, but the overall market structure maintained intact. This is what I want to get across. So not playing down the effects, and we get to that in a minute, like what actually happened, but saying, hey, it was bad. Even personally, yeah, I lost money too. But for me, it's like, yeah, it pretty much works as design. And this decentral approach, this, hey, give non-discriminatory access and have 24/7 markets that are always accessible actually leads to something like this, just as a preface. So now let's go into this. So I think the first question I usually get is, what actually triggered the wave of liquidations across major tokens, right? And I would say we need to delineate between the trigger and probably the root cause. The trigger definitely was, as you can see, because the correlation was high, the announcement of the Trump tariffs, right? Together with the positioning of one big trader. We know this by now. I'm not commenting on that. We saw markets declining much more than TradFi market, as I said, which isn't unusual because crypto markets operate 24/7 with free flow of information and no circuit breakers. So they are inherently more volatile and reactive, which in good times everyone likes, in those times no one likes it, right? Especially if you're long. That's not a flaw, but how the market was designed, and do your own research and proper risk management matter more than anything else. So, but now, why did we see so many liquidations? And I don't want to go into this and point fingers or say what others did. I can only tell you why at BitMEX we had way less liquidations and way less auto deleveragings in comparison to the market. And probably that gives you a little bit what happened. So we have no internal market makers. So we prioritize real organic liquidity over inflated order books, which isn't something that is, it's just like how you decide upon it. But it means if you see a lot of liquidity in a low volatile situation or sideways market, it vanishes like this in a crisis situation, right? It's like lending out an umbrella and you want to have it back when it starts to rain, right? Where we say, no, we don't want this to happen. We want to have a clear set of interests, right? We are a peer-to-peer exchange, and we want our designated market makers to perform in every market situations, or they won't get rewards. This is basically how we did it and how we do it. So in sideways market, we're always down the ranks in all the crypto exchange rankings because we have lower volumes. But in situations like these, our liquidity actually is addressable and tappable, right? So that's number one. Number two, we are transparent about the insurance fund. Everyone's transparent about that. That is not calling out anyone here. But what I mean is it works purely on a rules-based basis with no interference by individuals in its operation. What does it mean? It means in such high volatility environment, it just operates, meaning covering up for liquidated positions and making sure people get auto deleveraged as late as possible, right? So we have seen only ADL in low liquidity contracts with a few traders affected only, where there was no alternative to do so. In our high liquidity contracts, everything worked as wanted. So we had a lower level of liquidations and a way lower level of auto deleveraging, which is more what people complained about from my point of view. So, and then the last thing, which is from my point of view often overlooked, there is something that is called multi-asset margining, or it has different wordings in the market, which basically means you can put a lot of coins in your account and you get an equivalent credit for trading as collateral. If you trade, I mean, it's not for spot trading, it's really like for derivatives trading. So, however, if the haircuts are high, that means, let's say you use, I mean, hardly anyone does it, but you use, and again, I'm just picking it by chance, you use your bond to margin a Bitcoin contract. I mean, your haircut probably is between 30 and 50%. But it means as well, you're sent to liquidation 30 to 50% early. So that means if you have a movement in the market, a dip, that's just short term, like let's say 2 seconds or so, but it will hit this notion, your position will be liquidated, although your economic position is way better. So this in turn triggers further liquidations, because the liquidation goes into the order book, or wherever it's going to go. For us, it's going into the order book. It and creates more sell pressure, more pressure on the price. And this is actually what we saw. We saw internal or closely linked market makers. We saw insurance fund operations that were not 100% rules-based and automated or stopped in these situations, as well as multi-asset margining hitting high for people who have placed lower liquid collateral or lower value, lower or higher risk collateral like this. So they were actually liquidated early compared to their real economic situation, which created more sell pressure, which then created more sell pressure, and then you have a vicious cycle going on. So just coming from where we were and why we believe we had, I mean, we don't believe we saw, we had way less liquidations and way less ADLs compared to the market. And this is why. So, and now the question is who were hit, right? Because that was, you had discussions about that as well. So we see on BitMEX mainly three, let's say, categories of traders. I mean, there are more, right? But three who were exposed. One are high-risk traders who trade altcoins and perpetual swaps or dated futures with big open delta positions, that meaning directional positions, and high leverage on all the venues they trade on. They usually fall into a category that I call, like, they take responsibility for their risk taking and they're doing their own research. So they knew what they were getting themselves into. I mean, no one expects such an event, but they were not too much surprised. And they do risk management, which is way more important. So putting in stop loss orders or taking profit orders and the likes. Then the number two are, well, the crypto natives, the true believers with steady hands. They mainly trade spot and use perpetuals or dated futures as an overlay for yield enhancement, so basis trading or funding rate trades, but outright trades. And they usually trade Bitcoin at major layer ones in the majority. And then you have what you could call arbitrageurs, sophisticated firms, but as well individuals who take on hedging activities and open long shorts on different venues to take advantage of price differences between those exchanges. And we believe that the recent liquidation incidents have harmed mostly the latter group. If you, for example, look at momentum, traders were hedging airdrops. They woke up to 10 times spike and forced liquidations, not because their strategy was wrong, but because liquidity and pricing diverged across venues, right? And when one exchange freezes or misprices while another stays alive, hedges break, and even delta neutral traders or delta neutral strategies get wiped out. We somehow, I mean, we cannot avoid it because it's how traders position themselves. But we tried, I mean, we excelled actually in remaining continuous in terms of the system. So there were no discretionary breaks in pricing feeds or the likes. And in volatile markets, continuity is key. If one venue stops operating and the other one keeps on doing it, actually you might get liquidated while you're stuck with a loss-making position and you cannot close it, right? This is what happened. I mean, everyone was hit by it, of course, because if you wake up and something happened that you didn't foresee, well, you take a hit. But I think those last traders who did a lot of cross-venue strategies and relied too heavily on continuity without checking, they probably hit the hardest. Yeah.
Yeah, I mean, first of all, BitMEX was definitely one of the very first exchanges we all started, derivatives trading. For me, I had no experience, how derivatives worked or options work. And BitMEX was the only choice back then in 2016-17 that you had, where actually you could leverage something on Bitcoin or Ethereum, right? And to be frank, my first Bitcoin was I made on BitMEX only. My first Bitcoin I made on BitMEX actually.
Congrats.
Yeah, Bitcoin ran I think up to $22,000 in 2020-21, and that was the time at which actually we all came to know the power of this actually industry has. Now coming to this part, this is very interesting. I mean, because a lot of this particular collapse has been attributed to the market makers now. So retail finally got a taste that what actually market makers are, how they are working, and there is something called settlements in crypto as well. You rightly mentioned that BitMEX actually doesn't have such market makers. BitMEX is kind of making these settlements on their own, right? So maybe you can just shed some light on it more, because this is something that retail traders don't want to go into, to be frank. But I really want them to understand that your exchange is not just an exchange, right? There are certain third party players as well who are there and who also are responsible for this collapse in a way, right? So can you just help us understand how BitMEX is different when it comes to this market making process?
Yes, I mean, if we not going into basically how market makers operate, if you have a follow-up question, we can go into this as well, because it is somehow crucial to understand what it actually is and why this happens. So usually, or let me start with just briefly, a market maker is on a very easy level, basically everyone who puts in a market, a limit order is kind of making the market. So that means you don't buy outright with a market order, but you put in like a limit order, because then your liquidity, it's basically liquidity. So your order is posted on the order book and you can be executed against someone else who puts in a market order. That's it.
Right.
Market makers do that on a continuous basis. They actually want to earn money. And sorry, now I'm going into it, but I think it's necessary. They actually earn money by posting simultaneously buy and sell orders at the same time. And then they have a spread. So basically they say, I would buy for X and I would sell for Y. And they hope that someone comes with a market order. I mean, they don't hope for it, but then someone comes with a market order and says, I just want to buy or sell Bitcoin, for example. And then they are matched against those orders. And if you do that continuously and consistently, you might lose with single trades. But overall, you are delta neutral. That means you don't have a directional risk because you buy and sell at the same time, and you make money out of this spread. That's basically it. And you can do it on one venue, then usually it works very well, or you do it cross venue. And big professional market makers, wherever they are, basically do both. They do it on one venue, but they want to do, which is then falling into the arbitrageurs category. They want to arbitrage between different venues. So if the sell price is usually higher on one exchange than on the other, they buy on the latter and sell on the former, and they hope to get to be executed. So what then happens is, as I just said, one venue shuts down, they will close their position to not have an open risk, or they are liquidated on the one and they need to close on the other venue as well, which basically means if you are active, let's say on 5 venues, just one venue needs to start and you shut your positions on all the venues just to reduce your risks. It's just an internal thing. There is nothing bad about it. But that means the moment something like this happens, where markets deviate and where venues do not act in sync anymore, and you have no one to bridge this, market makers naturally, especially if they, and I come to that in 30 seconds, so they naturally reduce their risk exposure and reduce the liquidity they post on the platform, which actually, and this is often overlooked, has a ripple effect. The ripple effect is if the big market makers do not post that much liquidity anymore, and then people putting in a lot of and big market orders, you're running through the order book on one side and you just drag down the price. So this is number one, but this is more relevant from my point of view for spot markets. That's where it's most relevant because there you have a clear ripple effect. On derivatives venues or derivatives markets, it is the same but then different. What do I mean? Because you don't buy outright and you don't need so much capital, right? I mean, if you trade a perpetual swap, you need only a fraction of a Bitcoin to trade the exposure of a Bitcoin. So you have a benefit usually in the first, let's say, couple of minutes, hours, whatever you say in those markets, because you can have your position open for longer. However, the constraining effect is twofold. Number one is if your exchange, if your venue has a, let's call it skewed mark price mechanism. So for example, you're a derivatives venue and you only mark the futures and the perpetual price against your own spot market, and your spot market is breaking down, and you only have that one fee, it basically you have the ripple effect, but not because of the market maker, but because of the venue. Number two, if you have your mark price fee just from, which is the same, maybe a different venue, so you're not referring to yourself, which is good, but you refer to someone else, but only to one other party, and this party has an outage, you have the same problem. Because all of a sudden your mark pricing doesn't work anymore, and actually your P&L is not calculated in the right way, even if it's just for, let's say, 15 minutes, but in a high volatility phase, that can mean everything. So that means your positions are stalled, and the next moment that you get a mark price again, you might be liquidated and you can't do anything about it, which is bad for every trader. This has nothing to do with market makers, but market makers fear this in particular. Because if they are, let's say, offline for 15 minutes and the market is going crazy, they don't know where the market will, so to say, technically reopen again. So they try to cancel all the orders in between, right? So you have that ripple effect. So again, for us, we source, especially for the high liquidity contracts, the mark price from a multitude of venues. So that means if one venue goes, let's say they're not going down, but they don't feed the prices anymore reliably, we can still rely on basically an index. It's basically an index price that we calculate. The index is still valid enough. At least, I mean, if everything breaks down and we have a nuclear market, that's a different thing. But in the market like this, as we had it on 11th of October, it still went very well. And this is where we place a lot of emphasis on. Again, in sideways markets, in low volatility markets, people even complain about it because it creates less opportunities to make money. But in those situations, it's like a little bit of gold, right? So this is why market makers had an issue. And then the next one is in derivatives. So derivatives markets is basically mark price feeds plus availability of collateral, which means if you have volatility spikes, their collateral on the platforms might not be sufficient. So either they send into liquidations or they close their positions, which basically means vanishing liquidity, or they try to infuse more capital, but usually they need to rebalance. It's called rebalancing. We balance this from other venues. So for example, if there would be a need to place like 2 million more in collateral on BitMEX, they need to get it across, let's say, from, take a venue, Coinbase. So they need to withdraw from Coinbase International, send it to BitMEX, and then they can use it here. Here's the thing. Although crypto markets are 24/7 and on-chain settlement means near-time settlement, way better than TradFi, way better. It's often forgotten. Now everyone's like, yeah, look at this. I'm like, no, it's still way better than in TradFi. I worked in TradFi for more than 20 years. So I really know my game here. But the funny thing is, even in those markets, if you manage it in one block, let's say roughly 10 minutes, that is ages, right? You don't know what happens in between. And this is the big uncertainty where they start. Usually, if you don't, I mean, if the contracts are not set up in the right way, they usually pull that liquidity. So this is what happens. And then it goes like, as said before, then you have this vicious circle going on. At BitMEX, we engage, I mean, all venues or most venues do it like this. But we do certain things. Number one, we don't have our own market maker because an own market maker is exposed to that risk. Usually the market maker bears higher risk than a peer-to-peer exchange platform. Well, you can create way more money with it as well. This is just the upside of it, right? So, but then you have a conflict of interest what to do. Do you want to keep your market open for everyone else, or do you want to reduce your losses? Usually you go for reducing losses, one has to admit. I mean, again, it's open, people know it. It's nothing bad about it. You have a benefit in sideways and low volatility markets. You have a downside in high volatility markets, basically. We don't have that. We work with two sets of market makers, basically. One set is, we call them designated market makers, where they are, I mean, everyone says incentivized. Frankly, they are paid to post liquidity. And we have requirements in terms of what's the maximum spread and what's the minimum size they need to quote and how much uptime do they have. So yes, we allow for downtime, so to say, in quoting, but it's basically minimal. If they don't perform according to it, we won't pay them. So which basically means, again, it's more longer thing. It depends on how long it takes. If you have a situation like October 11th, and this goes on and on and on with Bitcoin going down to 20,000 from 120 to 20, I mean, it will break eventually, but we were good enough incentivized, basically, and aligned with our market makers that they still posted enough liquidity for us to come, or for our customers, basically, for the traders to go through this. That's number one. Number two, we have so-called direct market makers, which basically means it's open to the public. So every individual, every company who thinks they can quote consistently, but without any firm, I mean, not like very detailed requirements on spread and size. It's more like quoting continuously. They will get paid rebates basically on their fees. So, and those two together make sure that in the higher liquidity contracts, we have sufficient liquidity for those events.
Yeah, I mean, we definitely heard rumors after the event that there are certain big market makers who are going bankrupt because of this event. So definitely, I mean, this is something that retail investors should go deep dive into. When I say retail investors, I particularly mean crypto guys, because before this event, none of us was actually bothered even to know what a market maker is actually, you know. But before this event, there was an incident with a particular token called OM as well, where they cited the same reason, that their market maker pulled off the strings at the wrong time, right? So I mean, definitely a relationship of these exchanges, how they are working, how they're operating, is under scrutiny right now, and that's the right thing to have as well. And I'm glad that you were able to share with us that BitMEX actually is right now different from all of these exchanges. And I hope that people can hear this, people can listen to this, and hopefully BitMEX rises once again, you know, into that domain. The second trend that all have been seeing recently is something called perpetual dexes. All right.
Yes.
Hyperliquid definitely is right now leading the charts. Great volumes in billions. We even for a few days we even saw that overall Perp DEX volume was somewhere around 30% of the overall trading volume in crypto.
Yes.
It was even exceeding some of the centralized exchanges. So I wanted to know, first of all, your view about the future of this whole perpetual DEX thing. That do you really see some longevity to it, or do you see it as some form of, let's say, you know, stress-driven kind of a market? And secondly, what is BitMEX actually, you know, planning here? Is BitMEX also planning something like this, or is BitMEX going to be into the same kind of scope of things where actually risk management still remains to be the best of the services that you have?
All right. Yeah, interesting and good question, actually. And the answer is I would say not as, I mean, it's clear cut, but not as black and white, I'd say. So just to answer your latter one, we are not planning to set up a Perp DEX. And why is this the case? We believe that BitMEX always has been like the best centralized lookalike of a decentralized exchange. Why do we say this? A, we are crypto native, we are Bitcoin native, and our behavior is way more on a decentral level than on a centralized level. What do I mean? We have proof of reserves and liabilities, that's the thing, it's reserves and liabilities, that's regularly twice a week updated. We don't trade against our customers, as said. Our exchange does not run in-house market makers, right? Or improves volumes. We have zero exposure to venture capital money or other liabilities. We're fully funded through our operating profits and the original capital of the company. And we are a true peer-to-peer exchange. So that's super important for us and for our trading and transparency experience. So this is already an overlap, I would say, of probably 60% with Perp DEXs. So now the question is, what else is the edge of a Perp DEX? And the edge, from my point of view, is like decentralized derivative platforms like those offer aggressive trading, right? High leverage, fast order books, and it's a good tool for those who really know how to deal with extreme volatile markets at fast speeds and can evaluate the technology, because that's key. There is no one you can ask. I mean, there are teams, right? But there is no one to ask. There is no governing body. I mean, if you have a complaint, it will probably go nowhere. I mean, this is in the design of it, right? Where we say, no, this is the part where we want to be actually different to a Perp DEX, right? Then there is another aspect to it, which is Perp DEXs, let's say 3 major USPs, as I said, is it's for super high risk takers, often no KYC and heavy incentives, right? So being a venue for super high risk takers definitely is there to stay. There are people who want exactly this, right? Who know, and I alluded to them briefly in the beginning. So, but no KYC and heavy incentives are things that probably, regardless of what we would love to hear, right? I mean, have a shelf life for each venue, right? Especially heavy incentives usually work well until they don't anymore. And you see that you had other decentralized exchanges before. They're not gone, but they have gone big and then smaller again in relative terms. We now have Hyperliquid, same thing. So the question will be, how much of those incentives are there to stay, or is that just a virtuous cycle that goes upwards as long as you have higher incentives, more traders to come, higher incentives, more traders to come. If you break that cycle, it works the same way downwards. So you have a downward spiral in a vicious cycle. So, and I think this is the highest, I mean, not risk. I mean, I use Perp DEXs myself for certain aspects, I have to say. And I guess every trade, and not every trader, but many BitMEX traders do. But it's like, what do you look for? If you want to place a high risk bet, very fast, quickly, let's say it's traceable, but non-traceable in a way with privacy, go for it, of course. And it is there to stay. This is there to stay. Will it be the Perp DEXs we see today? I am not too sure. I would say if we have the same conversation in 3 years' time in the next bull run, we will talk about different names and different setups. This is my personal view. So whereas we as BitMEX, we aspire to be here the next, 11 years. Now 11 and 12 years counting. So, and I think this is the best way to distinguish between centralized exchanges offer usually a more risk-adjusted manner. Users still have the safety of accessing our customer support teams as well as our management teams, right? I mean, we are pretty visible, open, approachable, and you can rely on a third party should there be bigger issues with their funds or trading, right? And I think that's the reliability, safety aspect provided by centralized exchanges versus decentralized exchanges. I'd say, in short, higher rewards on decentralized exchanges, more stability, which is boredom in a way, but more stability in operations and risk management for a centralized exchange.
Since the starting of the podcast, you have been mentioning one thing again and again, and that's quite, that's something that crypto users are now exploring actually. Before this incident, they didn't explore it much, and that is called risk management, right? So one thing you have been highlighting since the start of the podcast, I think where BitMEX actually excels is more about risk management. So it's more about for traders who want to stay here for long and who are not just here on the hype version of the crypto, right? So I mean, that's wonderful to hear from somebody in crypto about risk management. First of all. So, Stephen, second thing, second trend that has been catching up now, and it's not something new, is
Mhm.
recent interest of Wall Street in crypto now. Not recent, but the recent moves that have accelerated
Yeah.
so far, right? So, we are seeing DATs, treasuries being made around certain coins. We are seeing lot of applications for ETFs, some of them getting approved as well. Lot of activity when it comes to CME, lot of activity when it comes to CFTC.
Mhm.
And I want to know from you, since you have been a person who has been into Web2 world as well, Wall Street as well for so long, that what should we conclude from this? I mean, is this really institutional getting adopted into this, or is it some kind of FOMO that is, making everybody attracted to this industry? So is it FOMO, or is it something long, long driven you see? It's something long term that you see here.
Um, Here again, I would bifurcate.
Okay.
If we speak about Bitcoin, and if we speak about the major and settled layer ones, for me, this is definitely here to stay,
Okay. Mm-hmm.
which seems to have happened very quickly with the pivot in the US. So with the election of the Trump administration. And it looked like, oh, that was sudden. I think that was more, it's not a grassroots
Mm-hmm.
movement, but something like a grassroots movement finally exploding.
Mm-hmm.
So, and why do I think this? I think number one, Bitcoin for now is accepted as, well, it's more a risk asset than a risk-free asset or a hedging asset. It's a risk-on asset. I had a brief post about that just
Mm-hmm.
recently. I truly believe that, but it's seen as a reserve asset that's independent of nation states. In the current global situation, this provides some value. It won't replace, and here I'm on a different train than some of the Bitcoin maximalists. I
Mm-hmm.
don't believe that Bitcoin will completely eradicate fiat money and that
Mm-hmm.
we go into a world where we only have private money, but it provides a valid and good alternative. And
Mm-hmm.
corporates, especially globally active ones, as well as wealthy people that are globally active, next to the everyday people like you and me who got into Bitcoin as an alternative, they
Mm-hmm.
see that value rising now as well. And this is Bitcoin. So this is why Bitcoin is the biggest asset and attracts the biggest interest of traditional institutional money, even nowadays from pension funds
Mm-hmm.
and sovereign wealth funds, right? And this is here to stay. For me, this is something that won't go away. We will go into a bear market eventually, but this won't go away. Number one. Then you have the layer ones. There it depends on what they sell in a way. Do you understand the use case? So if you speak about a word that I haven't heard for a longer period in crypto markets, but like coordination of distributed computing power, like Ethereum. Ethereum is basically this. They play the financial aspect of it, but it's basically this coordination. Solana is more or less the same.
Mm-hmm.
It is here to stay as well because that will fit well into the AI narrative and actually the delivery of cross-border AI agent coordination. That's very complicated, but basically means you have an AI agent from one jurisdiction, from another jurisdiction. If they would need to figure out in the fiat system how to settle, if they need to initiate payment, forget about this. They will go on a blockchain solution. This
Mm-hmm.
blockchain solution probably will be fueled or executed by one of the bigger layer ones as of today. Full stop. Stable
Mm-hmm.
coins go actually in the same direction. The stablecoin frenzy we have, I mean, it's not a frenzy. There is FOMO. It's not about stablecoins. Most of
Mm-hmm.
those projects that we see, I would label as corporate or enterprise blockchain projects. Because
Mm-hmm.
what they do is they use the regulation, especially the Genius Act, as something where they can put it into, but
Mm-hmm.
they overhaul their backend infrastructures. You
Mm-hmm.
might see those coins, but they are not for you. They are just in the background to enable remittances, which is what it was initiated. I mean, not the stable coin, but the blockchain for as well. So it's good that it happens, but it's nothing for a retail investor, right? And then you have all the other stuff like NFTs, meme coins, illiquid tokens, right, which is basically tier 2, tier 3, layer 1s and L2s and all of that stuff. There, I believe it will still be a pretty much retail-driven market. And there is interest from institutions, but they will pull back, at least in this cycle. Why? Because it's not big. What is often underestimated by the crypto guys is how much, at least, official liquidity those players have. Only Bitcoin, Ethereum, and a couple of the stable coins, including BNB, are big enough to provide a market that's liquid enough for them to say, we get in, we can get out. It works, we can risk manage, our models work, right? If you go already to Arbitrum or so, it doesn't work. It's not big enough. And it sounds bad. I don't mean that's criticism, but it's not big enough. It's too illiquid. So it will stay a retail market as it is for now. Maybe we will have more in the next cycle, but now this is it basically.
So, I mean, this raises a very big question when it comes to then. So there are right now, I think, at least 1,500 cryptocurrencies that we can kind of, they are listed somewhere, somewhere or the other, around 1,500 cryptocurrencies as per our data. So they may be on some small exchanges, but they are listed. So they are available to trade. And this raises a very big question that what's the future for these all cryptocurrencies? So many of these projects, most of these projects are trading driven only right now at the moment. Teams are saying that they are building something behind the scenes, but you don't have any as such a product or as such, let's say, revenue models backing it up for most of these cryptocurrencies. So, I mean, as you rightly said, that yes, layer ones are here. Layer ones may play a critical role when it comes to global finance, when it comes to global remittances, other use cases. But what do you see the future holds for these other cryptocurrencies? I mean, specifically, we call them utility tokens at the moment. But I think that particular definition is also now kind of narrowing down. It's not broadening; it's narrowing down now.
I mean, just personally, if you hear me discussing in private, I never call them cryptocurrencies. I always call them coins, full stop. I mean, the coin implies a currency in old times, but I refer as it's a token, right? It's a coin. So, and then the question is, what does it mean? It always was, but it was there was an overlay of hype and FOMO. So, and you could say very easy. I mean, it's very easy. It's like oversimplifying. There are just three questions to ask and then to answer. A, what is the, and it can be many things, but what is the utility, or what is the yield or the reference? Because it can be those three things. There is hardly anything more. So you can either provide a utility, which is the classical utility token, right? So you get a rebate, you get entry to certain fee tiers, for example, or you are paid something real in the end. So that's utility. Number two, you have a yield. It's like if you go to RWA, like, I mean, which is not like for what we discussed, but it's the same way of thinking. If you have real world assets, the question is, what is the underlying yield that is distributed to the token holder? Or number three, what is the reference that you provide? So for example, if you have tokenized equity, there is no yield on the equity because you don't get the dividends, but you have a reference to the price of the token. So what's the reference? So this is the starting point. What is it actually that you get? Do you get the utility as a holder? Or, I mean, and governance, basically governance tokens give you the utility of co-governing the chain, right? So what's the utility / governance aspect of it? What's the yield, or what's the reference that you get? Is there some? Question number one. Number two is, if this exists, what is the value of it? That sounds like the same question, but it isn't. What do I mean? If you have a utility token, the actual utility depends on how many people use the underlying service. If you have, let's say, tokenized equities, it depends on how many people are interested in that equity. If you have tokenized treasuries, how big is the market? What's supply and demand? Is there a dynamic supply and demand, right? Which is, up to now, if you talk meme coins, that was the community. Right? If you had supply, demand, and it was constantly interacting with each other. And then the third question is there an underlying revenue model?
Mm-hmm.
This answers the question, is that here to stay?
Mm-hmm.
So is this long-term viable or mid-term viable? Let's call it mid-term. I mean, long-term is something like 10 years in crypto. We think of in 6 month cycles. But is this here to stay? If you answer all of this question with, hey, yes, there is utility, yield, or a good reference. B, yes, there is a big, let's call it community for the sake, right? That actually is interested in that things. And number three, this project that comes up with the token or whatever you have actually can make money with it on a midterm basis. Then it's here to stay. It will be here because then it's a real business. If it isn't, then it's just like a narrative, something that's cute, something that's interesting. It probably isn't here to stay. It doesn't mean it's scam, which I often try to explain to even older people than I am. I'm like, look, you trade collectibles. If you trade sneakers, they still stay collectibles and they still stay sneakers.
Right.
But you can make money with it, and there is nothing bad about trading it. It's just not a financial asset. It doesn't work like an equity or a bond, right? And this is often underestimated as well. So I believe that many coins are here to stay, but equally many will vanish or just be forgotten at the bottom of the list. I mean, no disrespect to those projects. That's not what I'm after. I just want to make sure that traders are informed that they can do their own research and that they can classify what they have in front of them. And again, sorry, I repeat myself, going back to, does it provide utility or yield or reference? Will it be used by a lot of people? And is the project that actually supports this able to make money with it midterm? If the answer is yes, it's probably here to stay. If the answer is no, it's probably not to stay.
No, thanks, Stephen. I mean, this is a very good playbook, actually, to be frank. If anybody is listening, then this is, I think, the right way. Even the traders/investors, they should be approaching crypto industry, because not everything is a financial instrument. Not everything is backed by what essentially equities or private markets are backed by, right? So here, you will have to go into the project. You will have to check out the founders. You will have to do your due diligence yourself. There is no SEC. There is no government who is doing it for you here. So, I mean, thanks a lot for putting out this information. Uh, Stephen, another thing that, I mean, that has been in the news, had been in the headlines for so long now, is tokenization, right?
Yeah.
I mean, and I do personally, I have been advising a few projects now in the Middle East and US as well. And there is such a FOMO right now. I mean, for some reason, everybody just wants to tokenize everything, while they may not even understand what on-chain means, right? When you just, I mean, for them, on-chain is something just like, some black box, magic box that is full of liquidity, full of traders, full of retail investments. But that's not how it works, actually. The on-chain market is largely, by far, it's not regulated yet. And there are still a lot of questions to be answered when it comes to regulating the on-chain market as such, right? But tokenization, I mean, definitely tokens are far more easier to trade, far more easier to exit when it comes to private equities. So yes, there is a debate when it comes to equities versus tokens, when it comes to equities versus RWA. And I kind of, wanted you to help us understand a bit that why this is so crazy for the Wall Street, why Wall Street is so much attracted to this concept of tokenization.
Oh, I love this question. Thanks for that. I was expecting something slightly different because I was already thinking, oh, that will be very difficult. Just a couple of words as an introduction. In my previous, it's not career, but in my previous job, I was involved as well a lot in securitization.
Oh,
and actually, securitization is not so different from tokenization.
Yes,
it's basically, I always say tokenization or the RWA discussion is basically securitization 3.0. But this is a trad. I'm like in the middle of TradFi and crypto. I wouldn't never say I'm a real crypto native, but I'm closer to crypto natives than basically all of my peers.
Then you are the right person to help us understand this.
But why is Wall Street or any TradFi market so interested in this? There are a couple of reasons. Number one is and this is why the banks and the intermediaries are interested in it. It's in their mind, if they could open up a global, it's retail basically, retail demand for those assets, they can finance way more projects. What do I mean? If you have a, I don't know, Dubai or Singapore commercial real estate building, it usually costs like, let's say, $1 billion. And you are not allowed to sell this on the current regulations in any way, shape, or form to retail investors. You can go for REIT, so there are some measures already, but it's like not easy. And if you do it directly, so if you say, here's the builder or the developer, and here is the owner of it, and you need to bridge this, and you want to go one hop, you need to go for securitization. I mean, either you sell it outright, which is then a completely different set, but if you go for securitization, your minimum lots are basically $500,000 plus. So it limits the amount of people you can approach that you market this asset to. If you say, oh, wow, now I can sell that, and please don't get me wrong, to Thai retail investors in chunks of $5, they hope that, hey, we get access to funding that no one has ever had access to before, because those people they target do not even have bank accounts sometimes, or they only have low deposits or low savings. And it has nothing to do with the people, number one. This is why the intermediaries are after it. Number two, the current investors like the idea, because these days those assets, and I'm not talking about equities, we come to the equity part in a second. This is a completely different play. But the real world asset / tokenization discussion, which is about fractionalization and marketing it globally on chain, etc. So then the current owners of those assets love it, because they say, hey, nowadays, if I invest into those assets, I'm basically stuck. There is no exit liquidity in a very neutral way. Because if you buy this real estate, finding someone who wants to buy it from you just for investment is so super difficult, because you face the same things as the original issuer or the developer. So they hope for better exit liquidity. And then you have the developers or the original issuers who say, hey, if I can tap as well as the intermediaries into a bigger group of people that want to invest, I can reduce my financing costs. So the borrowing costs, basically, which is a big thing. And then there is even an accelerating layer where people, especially in countries that do not have access to those traditional securitization markets, say, we have no way of finding investors at a reasonable price for our projects, although those projects are good. For example, public housing would be something. Public housing in so-called, I mean, this is an outdated term, but developing markets, right? Especially ASEAN. I mean, exclude Singapore for a moment. But public housing markets, huge yields of private credit, right? In sub-investment grade. Huge market, really consistent high yields, but it's overly expensive investing and issuing, because you cannot channel it through the right channels. And if you have a direct channel, like to the end investor, it is way better. That's why they're all super interested in it. And this is for the real, this is what I call real tokenization. Then you have like the frenzy right now in tokenized equities and tokenized treasuries, interest-bearing deposits, all of that stuff. This plays slightly different from my perspective. It has two angles as well for Wall Street, so to say, or Wall Street banks and established TradFi banks. Number one is, and no one speaks, or hardly anyone speaks about that in public, it enables them to overhaul their backend infrastructures to a way more efficient operating system, so to say, which basically saves them costs and improves their profits, all other things being equal. That's number one. That's why they will do it anyway. That's why we see the stablecoin project. I mean, why should Walmart issue a stablecoin? It's basically to better settle their purchases, right? And distribute to partners and all of that stuff. So JP Morgan the same. They basically overhaul their accounting system in the back end. It's not so much for the stablecoin. Number two, they woke up that crypto natives are very wealthy these days. The crypto natives do not want to open up a securities account with a classic brokerage platform. That's
This
it.
is interesting.
So they have their wallet, and if you provide them with an asset that is de-risking them, actually, tokenized equities and tokenized treasuries are a completely de-risking strategy for wealthy crypto natives. They don't need to stay in the crypto coins, right? They can say, hey, 20% of my portfolio now is in treasuries, which is like, we can discuss about sovereign risk these days, but it's basically a low risk asset compared to others.
Yes.
They couldn't tap into this because they were debanked in the last cycle. They are not able to open up bank accounts, or they won't get the risk ratings, or whatever you have. They cannot on and off ramp, right? I mean, they cannot or only at high costs or high efforts. But if you give them this in their infrastructure, they will buy it like hell. And this is what we see. So actually, this RWA narrative that works right now with especially tokenized treasuries and tokenized equities is basically the TradFi banks distributing their assets on a different channel. They have missed distributing crypto to their audience, but they don't want to miss out in selling their asset to the crypto natives. And this is what happens from my point. So I give you an example. For me, again, old guy, having been in TradFi, I have irregular bank accounts. I buy my treasuries in my regular brokerage account, and I buy my equities in my usual regular bank account. Why? Because for me, it's cheaper than doing it in a tokenized way. It's the same way as I have wallets, and if I want to buy Bitcoin, I buy Bitcoin outright. I don't buy an ETF. I would be stupid. I can do it myself.
Right.
Because I have those two rails, I can choose where to put my money into, right? If you are crypto native, you don't have that second rail, but basically you now have kind of an entry point into this via the RWA. So this is why this is like going crazy for the right reasons, actually. But this is what happened. My read of the situation.
Yeah. I mean, so liquidity still is a concern that I see. I mean, a lot of projects have been tokenized. We ourselves have tokenized, I guess, somewhere around $3.5 billion worth of now real estate plus arts, maritime assets. But the challenge that neither the asset owners want to discuss right now and neither service providers is that how we are going to bring so much of liquidity, because these assets are actually securities, right? So they are going to be traded on something backed by SEC or some securitized asset only. I mean, exchange only. You cannot sell them as utilities. So this is where my next question is that where do you see this liquidity coming from now? Do you see platforms like Securitize in US, which are a regulated platform, which are right now being regulated under the US jurisdiction? Or do you see current centralized exchanges actually playing a role in bringing liquidity to these RWA?
You point at one of, I just love the number 3, but I think it's 3. Let me dive into it. But 1 out of 3, let's say, nuts to crack in this space. I believe it works right now for those, let's say, tokenized treasuries and equities, because you can sell them as so-called asset reference tokens. So you have regulation that works in the crypto space. So I believe there will be liquidity coming for those, as I said, from the crypto natives. For this real tokenization and fractionalization, it is, as you say, there is no solution found. It could be done by the classical players. They could bring it on chain and then distribute it, but it would require them to get into the crypto world, and they don't want this.
Mm.
They don't want to, I always say they don't want to get their hands dirty themselves. They would need another intermediary. But if you have another intermediary, it gets more costly and it eats up actually the benefit of doing this.
Mhm.
I believe the crypto world would love to do this,
Mhm.
but they struggle with this concept. So tokenizing, let's call it valid and stable assets, would be very difficult, because just imagine Chinese exchange tokenizing and then selling US corporate real estate.
Mhm.
Someone would just come around the corner and say, we need to sue those guys, even with the current administration in the US, right? So this is very difficult. So that leaves you with assets that
Mhm.
have, so this is number one. Number two, what I mean is, and this goes into the second one, this means it would leave you with assets that are not
Mhm.
battle tested yet. So I'll give you an example. If you say, I'll tokenize a public housing project, might be huge, might be big enough to do that,
Mhm.
on the Philippines, and I
Mhm.
sell this to Thai retail investors. I
Mhm.
think regulatory wise, it should be somewhat okay. So that
Mhm.
might work. But just imagine, how do you enforce your property rights? What do you do if there is a dispute? Because that's the thing. In equities and in bonds, that has been battle tested through first, the original setup of those instruments, second, when they were dematerialized and for electronic trading, and third, via securitization laws. So, and we went through this. So everyone adheres to the rules, everyone knows how to play the game. So you are pretty sure that you get what you are entitled to.
Mhm.
But if you have a dispute there, how should a Thai retail investor with an exposure of 50 US dollars enforce their rights in the Philippines?
Mhm.
Who will take on this risk? Who will guarantee for it? So far,
Mhm.
no one. So this
Mhm.
hampers or restricts liquidity right now too, because people who really want to do it know this, and they're looking out for those solutions that they're not there. It's like in private credit; it's exactly the same.
Mhm.
How do you ensure that you receive your recovery rate on this? Not quite sure, right? Because it's the cross-border aspect of it, which is the biggest thing here. So the GCC does it very well in real estate, for example, because they build it into national law. So you know, if I hold this, it
Mhm.
actually is a representation of a legal title. It is
Mhm.
not a wrapper. It is not something that's on top and overlaid and this and this and this and this, and I need to go all the way down. It's just like, no, it's mine and it works, and I can go to a GCC court and they will
Mhm.
rule in favor of me. I mean, if I'm right, right? So this is pretty good. And the
Mhm.
third one is, and here again, this is liquidity.
Mhm.
Many of those assets, the real kicker is, are illiquid for a reason. Because
Mhm.
the tower I'm sitting in here in Singapore might have cost the same as a tower you work in Dubai, right, or wherever you are. Just take the Dubai example, and they might even look the same way, but their value might deviate greatly over time.
Mhm.
So who provides the mark price for that?
Mhm.
We don't have that. So, and
Mhm.
how should again, Thai retail investor be able to say what is a good sell price? Should I
Mhm.
actually sell because it deteriorated in value and I'd rather get something now better than getting less in the future? Or should I rather sit and wait because it will appreciate in value because of whatever trend there is? Right? So global trends, macro trends, okay, you can monitor yourself, but those things require know-how about the, especially real estate, know-how about the asset, how well
Mhm.
maintained it is, then it's a dispute resolution, and all of this unfortunately has not been solved yet because the tech guys thought, oh, it's just a tech thing, and I need to provide this electronic token, and I need to be able to mint something. No, and the
Mhm.
legal guys, so far, it changes. I believe that's the next cycle. But the
Yes,
legal
yes.
guys, so far, and the TradFi guys didn't want to touch anything that was just that remotely related to crypto. This, fortunately, is solved now, but I believe it will take the better part of the next cycle to get over it.
Yeah, I mean, from the side of the real estate developers, if you see, they do see a value when it comes to bringing global liquidity to their current inventory, to their
Yes.
current assets. I do see that legality wise also we do have certain jurisdictions who are now giving out these licenses, token issuance licenses particularly, right?
Yeah.
But I don't see exchanges still taking a bet on it. I mean, so
Mhm.
what's the BitMEX take here? Will we see RWA tokens listed on BitMEX soon?
Oh, I mean, we love. I mean, we'd love to do it. Full stop.
Okay.
But as we are a derivatives exchange, we would look for issuing perpetual swaps and dated futures on
Mhm.
those. So we are a little bit dependent on, we need the first projects who run
Mhm.
well enough first, and where we have a mark price. We spoke about mark pricing and the importance of that, especially in difficult market
Mhm.
situations earlier,
Mhm.
to actually do this.
Mhm.
So yes, we look actively, but this is easier, still
Mhm.
difficult, but easier for equity perpetuals. It's still a
Mhm.
market price issue, a big one actually, because it's a 24/7 market compared to trading hours in the markets you're in, and you have risks in between, so you need to cover for those. And as we spoke earlier, we are not a market maker ourselves; we won't take the risk ourselves. So this is something that will be, I guess, first. I
Mhm.
would personally, just for me, love to do something in the more illiquid market like private credit and real estate, but it said it requires a reliable mark price feed. And this, we haven't seen particularly good solutions that work 24/7 yet.
Mhm. Yeah. So, Stephen, first of all, congratulations for running BitMEX so successfully, navigating the down risks, downtrends that are in crypto right now. And I mean, as we have been discussing throughout, you have been very much highlighting the core, which is still not there in crypto. That is basically the risk management part. And I hope people who are hearing today through BitMEX, through you, will be able to kind of deep dive into this and select an exchange not just based on the number of tokens or the number of coins available, but actually based on that which exchange is actually providing them the risk management, inbuilt risk management when it comes to the things that happened on, like, 11th of October.
Mhm.
So my last question to you, Stephen, is regarding BitMEX only again, that
Okay.
given the current trends, given so much happening in crypto, so much happening in global macroeconomics, what do you envision for BitMEX in next, let's say, 5 years, 10 years? What is your vision here? That okay, this is where BitMEX is going. This is what I see BitMEX kind of bringing on table in soon.
Couple of things. Number one is, and this is more the protection thing that you mentioned. One thing is to win something. The other one is to not lose it. We
Hmm.
want to still. I mean, we and we need to get back. And you alluded to that to both.
Crypto
We are
traders are
very
learning
good
this.
at,
I can tell you
we are
that.
we are good at not losing. This is what we excel at, even internally. We are very
Yeah.
good at not losing stuff, right? So
Hmm.
it's that thing like, not your keys, not your coins. Don't lose the fucking Bitcoin. This is
Hmm.
really who we are. It's like the risk management, all of that stuff.
Hmm. Wow.
But we
Hmm.
need to relearn again to win, right? Number
Hmm.
one. This is what I want to do, and this is at the core of what I do every day with my team, and where
Hmm.
we try to build. How do we
Hmm.
do it? I think the next cycle, in a way, leaving aside volumes, is actually again our cycle. Why? Because we can provide that bridge from, let's say, TradFi to crypto.
Hmm.
We operate an institutional grade exchange. We provide a peer-to-peer exchange. We do risk management, which was actually the biggest innovation of our founders. It was, everyone looks at the perpetual swap to make something tradable. But my view is they actually provided the framework for trustless trading without entry requirements, so non-discriminatory access. This is what they did. So, and this is especially relevant now. Now we have institutional money inflowing, and they will look for institutional grade risk management, security, safety, and operations, and we have that. At the
Hmm.
same time, we are still Bitcoiners, and we love this thing of non-discriminatory access. We want to bring together institutions and individuals on a level playing field,
Hmm.
not to scam, not to take over, not to just rid them of money, but really to, so that they can interact with each
Hmm.
other directly without intermediaries, cut out the middleman. And then this is what we want to do, and we believe this is really something that will happen in the next 2 years. And then what do we bring to the table for the instis? I said this, but for the retailers, we want to basically bring, the crypto equivalent of passive investment to the place. It
Okay.
sounds like, so in TradFi you have ETFs. If you
Mm-hmm.
don't know what you should do,
Mm-hmm.
you buy ETFs, you buy index trackers, what have you.
Mm-hmm.
In crypto, we don't have that. And
Mm-hmm.
there are different reasons for that. Why? Because the market isn't that big. We had that. So where's the big liquidity? You have hundreds of coins where you say, not really a thing, right? So how do you do that? So you end up in being a Bitcoiner, or you might invest into Ethereum or into Solana, and then you stop. Then you don't
Mm-hmm.
need it. But if you go further, then you can do it. But your passive investment is not like buying an ETF. Your passive investment is following successful, traders and trading patterns, behaviors. And this is what we work on right now, so that you basically can say, even as a not so consistent trader, you say, you know what? Here's a strategy I think that's going well. Here's a trader I want to copy. So copy trading would be technologically the thing, and this is there. So it's nothing new. But how can you do it? So you can allocate certain amounts of your portfolio, not like following one at the
Mm-hmm.
exact same exposure that they have, or with 100%, but saying I want to have, let's say, 15% of Arthur Hayes, 20% of Stefan, uh, 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 50% of Krishna, or you even say, you know what, those guys are great, but they are actually negative alpha, like Kramer. Like I want to do the exact opposite of Arthur Hayes, or the exact opposite of Stefan, right? So it's more about the triggers. And this is the best thing you can get as passive investment. It requires more than just what I said now. This is easy. Everyone can voice this. But building that in a way that it works and that it actually gets you superior returns is something we aspire and to deliver in 2026.
So this is cool. This is cool. I mean, if I had a chance to, let's say, follow Arthur today, given his track record, given his not only just his trading track record, but also his investments into new coins that you can easily follow at some of the other websites today. If I can
Exactly.
get that investment slash trading flavor on one exchange, then yes, why not? I mean, uh, so recently you must have seen that a lot of these platforms allow you to entry at a certain before
Yeah.
TG event, before the token generation event even, right? And
Yes.
most of the investors they entry at that point, not after TG is done. So I mean, if I can follow such investors on a big
Mhm.
exchange like BitMEX, I mean, I would definitely do. Given the risk parameters, the risk management is far more superior here as compared to my exposure at other exchanges. So this would be
Mhm.
cool. I mean, how soon we are getting this?
Well, as soon as possible. I mean, we are really on it. We are really on it. But I don't want to promise something that we can't stay true to, because I said the devil is in the details here. The idea is not easily, but the idea is easily understandable. It's intuitive. But as you say, it's like, how do you risk manage? How do you make sure that the
Mhm.
timing isn't bad, right? So that it's actually misused by front runners or so. How can we make sure that you can get that even cross venue, not just on one venue, right?
Mhm.
So how do we do this on chain? But again, it's a timing matter, right? How fast can we
Mhm.
get into how does it actually work in downturn scenarios? So if it works against you, that you are not, I mean, it's the same thing like with liquidations, that you're not stuck too much in positions that you shouldn't be stuck in, right? This is all what we need to figure out. So, and but we have said we want to solve that puzzle, and we will solve it in 2026, which is just 6 weeks around the corner.
I mean, this is something that I really I know. I mean, these kind of setbacks which crypto is facing right now, in a way, they are important as well because we are finally understanding the value of risk management. We are finally understanding the value of not losing money as compared to making money, right? Because if you keep on making money on one side and on the other side you're continuously losing it, there is
Exactly.
there is gonna be depression at some point in time for you. So I mean, this podcast was very different from others in a way because we are discussing something that crypto traders or native crypto people they really need to hear right now. I mean, they really need to get out of that particular area where they're just focusing on the next 1000x 10x coin and not focusing on that. Okay, my money is actually exposed, I can lose it in just one event, and one
Mhm.
event, I'm just one event away from my bankruptcy, right? So I mean, thanks Stephen. I mean, this was more of an education session, I think, than as compared to a podcast. But you have been an amazing You're an amazing educator, a mentor so far in this podcast. Thanks a lot for sharing all this information. I do have one last question for you, and this is a question we ask to everybody. It's a very
Mhm.
basic question, but it gives us kind of the mindset of the other person as an investor, also because I know you own cryptocurrencies, anyways. So, if you had $1,000 today,
Yes.
how would you invest it, and where would you invest in crypto?
Tier two, layer ones.
Ah, okay, okay. So you're gonna stick with the ones that have actually the kind of liquidity that you see Wall Street demanding right now.
Yeah, for me, it's I would go for the ones that are not in focus right now, but where the
Mhm.
chance is high that they will get in focus, and then it's exploding. It's a risky strategy. It's not like keeping my money. I might lose some, but it's like I would go. I mean, I want to go for a 10 bagger. That's it. So not a thousand times, but 10
That's
times.
what people are in crypto for. Yeah, yeah. All right, Stephen, it was wonderful talking to you. Thanks a lot for your time. I know I took more than the allowed and allocated time today. Thanks a lot. It was wonderful talking to you. And
Same
hopefully
here.
we can contact again, we can align again. And to all my viewers, to all the podcast listeners, Stephen BitMEX, you already know about it. But again, you can go check out them. You can subscribe their channels. You can register for an account there. And as Stephen rightly has been discussing from the starting to the end, BitMEX still remains to be one of the best exchanges when it comes to saving your money, when it comes to giving the risk management that you need, which everybody in crypto needs right now.
Yes. Thanks a lot. It was a pleasure. And yeah, see you soon. I mean, happy to come back, of course.